October 27, 1929. A Sunday. Across America, millions slept soundly, secure in the belief that prosperity was their birthright. Their wealth, they thought, was genius, not chance. They had discovered the secret, a permanent plateau where markets only went up. But the blueprint of this disaster will look painfully familiar to us today. Beneath the surface of jazz and fast cars, the greatest financial fantasy in American history was about to shatter. This is the story of how collective confidence became a collective delusion, and how the pursuit of quick riches paved the road to ruin. The 1920s were intoxicated. America was the world's creditor. Factories boomed. Radios, refrigerators, and automobiles poured out, accessible to the middle class through a dangerous new concept, consumer credit. People didn't just feel rich, they acted rich. The stock market ceased to be an investment tool, it became the national sport. Barbers traded tips, taxi drivers boasted. Between 1924 and 1929, the Dow Jones Industrial Average tripled. Everyone who bought early looked like a prophet. The greatest minds assured them this was permanent. In October 1929, the celebrated Yale economist, Irving Fisher, famously declared that stock prices had reached a permanently high plateau. When the experts believed the propaganda, the doom is sealed. But the engine driving this ascent was not true growth, it was leverage. Brokers offered buying on margin. You could buy a $100 stock with just $10 of your own money, borrowing the rest. If the stock rose, your profit was magnified 10 times. If it fell, nobody discussed falling. They believed the borrowed money was practically free. By 1929, over $6 billion in broker loans, a colossal sum, was riding on one fragile assumption, that stocks would never, ever fall far enough to matter. The entire nation was betting its future on paper promises. ACT2, the cracks in the foundation. The house of cards was trembling long before the storm hit. Corporate profits weren't keeping pace with the astronomical stock prices. Farm economies were collapsing, crushed by overproduction and ignored by the urban elite. And the Federal Reserve, uneasy, began raising interest rates, the one thing that made heavily leveraged debt unsustainable. A few voices screamed warnings. Financial forecaster Roger Babson repeatedly predicted a crash. He was ridiculed, dismissed as a pessimist who missed the greatest show on earth. The noise of celebration drowned out the truth. Millions of Americans, teachers, clerks, factory workers, had sunk their entire life savings into this highly volatile market. The entire economy had become dependent on one fragile belief, that consumption, supported by ever-rising paper wealth, could expand forever. In September, the market suffered a sudden, sharp drop, the Babson break. It was quickly covered up. The papers called it a healthy correction. Smart money began quietly moving to the sidelines. But the public, conditioned to buy every dip, rushed in. They were walking into a trap. That Sunday, October 27, families planned their futures based on wealth secured by thin air and borrowed money. They trusted the system. They believed they had mastered the secret to wealth without work. They went to sleep confident. They woke up to Monday. ACT3, Black Monday, the faith shattered. Monday, October 28. The air was thick with dread. At 10 a.m., the opening bell rang. Prices did not surge. They wavered. And then, the selling began. General Electric, a market darling, opened lower. RCA stumbled. Whispers of fear began to spread, replacing the years of boastful confidence. The expected script, that smart money would buy the dip, never played out. The professionals weren't buying, they were silently liquidating. They understood the core weakness. In a leveraged market, confidence is not helpful, it is essential. And confidence was cracking. By noon, the weakness was impossible to ignore. Stocks were down 10, 15, 20%. The ticker tape began to lag, unable to keep up with the flood of sell orders. Margin calls became a constant, terrifying drumbeat. Brokers demanded immediate cash from investors whose collateral was shrinking. Find cash, or your positions are liquidated. The psychological shift was devastating. Investors confident at breakfast were questioning everything by lunch. The market was a mirror of collective belief. And that mirror was fracturing in real time. The reality of borrowed money hit hard. Men who had borrowed against their homes, their businesses, and their children's futures now faced a choice: sell at a loss or lose everything in liquidation. Every forced sale by a margined investor pushed the price lower, triggering more margin calls. A self-feeding cascade of destruction. The Dow Jones Industrial Average lost over 12% in a single day. Billions vanished. Yet, even as Monday ended, the newspapers tried to maintain confidence. Editorials insisted that fundamental strength remained intact. But in brokerage houses, clerks worked through the night, their hands shaking as they calculated the impossible demands they would make on their clients tomorrow. The real fear was waiting for the Tuesday morning bell. ACT4, Black Tuesday, the system fails. Tuesday, October 29th. It arrived like a funeral procession. Overnight, global markets had plummeted. The selling wave was racing across the Atlantic like a financial tsunami. At 10 a.m., the selling began immediately and intensely. No hesitation. Orders to sell poured onto the trading floor. General Motors fell 20 points. Westinghouse, 30. RCA collapsed so quickly traders couldn't keep up. The ticker tape, the scorecard of prosperity, became an instrument of torture, lagging further and further behind. Investors were trading blind, selling based on fear, not on fact. The volume was unprecedented, 16 million shares traded. The machinery of American finance, which had seemed so sophisticated, proved fragile and inadequate when tested by genuine panic. The cascade of margin calls became an avalanche. Brokers began liquidating accounts without permission, selling stocks at any price to recover their loans. This was the moment everything broke. Each liquidation triggered more margin calls, pushing prices further down in a death spiral. This was the ultimate betrayal. The losses weren't just hitting individual speculators, they were hitting the banks and insurance companies who had treated stock portfolios as solid collateral. News section, the secret bankers meeting. By midday, the situation had escalated beyond individual trading houses. The most powerful financiers in America, J.P. Morgan Jr., Thomas Lamont, representing Morgan Bank, Albert Wiggins of Chase Bank, and others, gathered in an emergency session, not to profit, but to stage a desperate rescue. They decided to pool their resources, tens of millions of dollars, to purchase a massive block of blue-chip stocks. The goal was purely psychological, to show the public that the titans still believed in the market. Thomas Lamont walked onto the floor and, in a dramatic gesture, placed a large, visible bid for U.S. Steel, well above the market price. For one brief, shining moment, the panic paused. But it was too late. The collective fear was a force of nature, and no amount of banker money could stop the tide of leveraged liquidation that still lurked beneath the surface. The brief rally evaporated, and the selling resumed with renewed fury. As Tuesday wore on, the disaster was undeniable. This was not a correction. This was the collapse of a financial structure built on borrowed money and borrowed time. The party that seemed eternal ended with a crash that would echo for generations. ACTV, the lingering lesson, the cost of confidence. The 29th of October, 1929, was the moment an entire nation discovered that prosperity built on borrowed confidence is not prosperity at all. It is a dangerous illusion that evaporates in hours. The millions who went to bed wealthy on Sunday and woke up ruined by Wednesday learned a harsh lesson: markets do not reward blind faith forever. News section, the immediate societal shock, the financial collapse instantly metastasized into the Great Depression. Factory orders stopped. Banks failed, taking innocent depositors' cash with them. Unemployment soared past 25%. The failure of Wall Street was not just a rich man's problem, it became the poverty of every man, woman, and child in America. The societal shock was immediate. Stories of speculators jumping from high windows, though often exaggerated, captured the era's despair. But the real tragedy was quieter, the sudden, crushing realization by millions of ordinary families that the life savings, the retirement funds, and the college dreams were gone. The city streets were filled not just with panicked sellers, but with newly unemployed brokers and clerks, wondering how they would face their families. The crash of 1929 was the inevitable result of believing that this time was different. This delusion lives on in every bubble since, the dot-com bust, the 2008 housing crisis. The names change, the assets change, but the core psychological flaw, leveraged confidence, remains the same. History doesn't repeat itself, but if you ignore its warnings, it will crush you all the same. If this terrifying history gave you a new perspective on risk and the danger of mass delusion, show your support by hitting the subscribe button. Don't let the lessons of the past be lost. We bring you the Sanjin, serious/grave, stories that reveal the dark truths of finance. Subscribe now, and ensure you're warned before the next great illusion shatters.